Janet, let's talk a little bit about what's going on in the UK, if we could first, and then pivot to other parts of Europe. If we talk about the United Kingdom and where we are on the Bank of England's trajectory, I know that HSBC. Are you an outlier in your expectations around where the Bank of England goes next? Certainly you don't expect a rate hike this year, and you don't expect one next either.
That's right. Actually, our UK economists were very early to the May rate call. They long said that the Bank of England would deliver a rate rise in May. Of course, the market went to 95% priced in. Then it became very clear that the bank wasn't going to deliver. So whereas a lot of houses snowploughed the forecast to either August or November or beyond, our UK economists took the view that that was the window for a rate rise, that actually, assuming a stable currency from here, inflation should be coming down quite quickly. And remember, we are coming off that very weak Q1 figure. The jury is out on how much of that was weather-related, how much of the 0.1. And over the next few months, we'll get a lot of revisions in the famous Blue Book from past data, but probably not the Q1 figure. So I think the Bank of England's in no hurry. We've got no rate rise at all. But if the labour market continues to strengthen and if we get upside surprises on the wage data, then we could be wrong. But we don't see that yet.
Have the rate hikes we've seen been justified by the data, or have they been more about getting the Bank of England to a place where it can then cut again, should it need to?
I don't think raising rates just so you've got room to cut them is necessarily an appropriate strategy. I think the UK economy, well, the global economy, since the middle of 2016, when we had the vote, the global economy has been stronger than expected. You know, last year the Eurozone economy grew at 2.5%. The UK was weaker, but was certainly better than had previously been expected, helped by that export story to some degree. So I think the first rate rise probably was justified. And the need to tighten policy further when actually, you know, we saw the construction data yesterday was softer. We've seen signs of the housing market slowing down. The only reason why they would want to tighten at this stage would be if the labour market continues to tighten by more than expected and they see it in wage data. For a few months you saw it, but if anything, there's been a bit of a loss of momentum on the wage data more recently.
It does seem possible that we could get to a climax in the Brexit negotiations around June, or possibly later in the year. The spokesperson for Theresa May yesterday saying they're working towards, you know, June's just a staging post to the talks later on in the year. Away from the politics, though, what will you be watching for in the data to assess how resilient the UK economy is proving to be in the face of Brexit? Because a lot of that, fixed asset investment and things, it takes a long time to get that kind of data. So what will you be looking at for the real clues, the real insight?
Right, well, I think June is looking less and less likely, partly because Europe's got a very busy June summit already. They'll be discussing Greece, they'll be discussing Italy, they'll be discussing European integration, and of course there was going to be this discussion regarding the Brexit negotiations. So I think that probably does get pushed a little bit later. Yeah. So we will be looking for all the survey data. That tends to be, you know, what's it saying about investment spending? What are we seeing in terms of high-profile announcement, in terms of whether we're going to see further job shifts, but also migration flows. Obviously, we've seen a slowdown in the number of migrants coming in from elsewhere. That has implications from the labour market data. But if I had to pick one single release, it would be the average earnings release will be the one that we'll continue to put the most attention on.